New friends, new opportunities, new partners. EG Tax.
Hi, I'm Esther Goliath, the Tax Lady, and if you see us on Ask the Tax Lady here on WBBZ, then you know it's tax season. And we have our roving reporter out in the field meeting with you asking tax questions, and then we answer them for you. And so every week we do that here on WBBZ, and on Saturdays on WBEN we're on from 3 to 4, and I'm joined in studio with my absolute great helpers, Christopher Fabian, Tiffany Fabian, my daughter and son-in-law, and we're kind of like the brains behind EG Tax, although we have a great staff, and this show is all about saving you money so you understand your taxes, and we hope that you'll stay with us while we do this show. We're looking forward to helping you, and we'll see you after.
Attention real estate investors. Thinking of buying or selling real estate investment property? Call R.J. Gullo Companies, qualified intermediaries for 1031 exchanges and real estate investment specialists at 716-675-1500 or visit them online at rjgullo.com. For a free consultation when buying or selling real estate investment property or to pay no tax through a 1031 exchange, let R.J. Gullo Companies put their 40 years of experience to work for you. Call R.J. Gullo Companies at 716-675-1500 or visit them online at rjgullo.com.
I'm attorney Dennis Kitchen. Now is a good time to look at your finances and your debts. How much debt do you have right now? If you don't know, or if you don't want to know, it may be too much. Isn't it time that you talk to an attorney about a fresh start? I've been helping many people in debt over the years, and I don't charge for an initial consultation about debts. Call for a free consultation. I'm Dennis Kitchen, and I'd like to help.
I've been receiving alimony for 5 years now, but every year I owe the IRS in New York a ton of money. What can I do to cut down the tax bill I get? I just can't seem to get out from under the tax man.
Well, I mean, we were talking about that from the first part of the show about alimony. Well, it's obviously a pre-2019 divorce because it was taxable, so it's going to stay taxable. To me, what you really need to do is get out from under.
Wait.
Yes.
Sorry. She can go back to court and request that the alimony going forward does not count as income.
But they'd have to.
But they could, I mean, this is where the lawyers could say, instead of getting $10,000 a month, I'll take $8,000 a month.
Right.
So he still gets a break because he may not be able to deduct it, but he's paying less. She doesn't have to claim it as income. So going forward, you can do that.
But be very careful, because just because if you did negotiate like that, because going forward it wouldn't be taxable
But-
if you did have it modified.
One thing she could do is she could put money into a traditional IRA every year,
Right.
and that would be an adjustment to income. So this lady who owes every year because of the alimony, she could.
Well, she needs to do estimates too.
Yes.
She needs to do estimates, so she prepays it.
Right.
If she can't get ahead of the ball game, I would suggest she even do a home equity or some type of loan to get current so she can
And
do
then
that.
don't forget, if she has children and her alimony isn't that high, she should get a job, because then she'd get the earned income credit, which is huge,
That's
huge,
correct.
huge.
That's
So
correct.
if she was somebody who's getting alimony and she doesn't make a lot of money, just go get a small job, even if it's babysitting, cleaning houses. A small job, you'll get this nice, big, huge earned income credit
Right.
on the
If
federal
her
and
income's lower.
the
Correct.
state return.
Correct,
So
correct.
get a job.
But
I mean, you always say
Get a
that.
job.
Get a
That's
job.
true.
Even
That's
around
true.
Christmas time.
Right.
Or after
right.
Christmas.
All right. So the bottom line here is alimony going forward, if you have it modified, is not going to be taxable. So what, like Chris is saying, sometimes the art of the deal would be, I'm going to give you a little less, but it's not going to be taxable, and so we're modifying it because it's a win-win. But it has to be so it makes economic sense. Remember, if you're giving up $2,000 in a year, it's 2,000 real dollars, and if she's in the 10% bracket, she's saving $200 in taxes, where he's saving
Right,
2,000
that's
real
where you
dollars.
gotta-
So you got to really put a pencil to it, right?
Yep.
Hi Esther, I have a question. I want to move to Florida to get out of the snow, but I have 2 rental houses that are paid for, and I heard that I'd end up paying a ton in taxes. What if I hold the mortgage? Would that help me tax-wise?
Okay, so that's a great question.
So the truth is, if you hold the mortgage, that won't make any difference. You're still selling the houses. And so I'm thinking a good idea would be a real estate exchange for you. That way you can exchange it for property in Florida, because if we back up here, the truth is if you sell those rentals or if you hold the mortgage, that's considered a sale, and then you have to pay all those capital gains on that depreciation.
Over time.
Yes,
Yeah.
yes.
Right.
So, okay, let me kind of build on what she said. It is true, if you sell those rentals, not only is it going to be a capital gain, but you have to recapture all the depreciation taken on those. So if you paid, let's say, $500,000 for the rentals, and you sell them for $1 million, and you've depreciated them out over 27 and a half years, their basis is zero, and so you're gonna have a $1 million gain,
Yep.
right? Which, you don't have to be a rocket scientist, that costs money. Now, your options then are, if you hold the mortgage, it is true that, like Tiffany says, you're gonna pay taxes on it, but you will pay a little bit a year on an installment sale over the life of the mortgage that you hold, okay? The second option that she alluded to was to do an exchange. Now, here comes the part that people don't necessarily like. An exchange only works if you get more investment property in the new area that you're moving to, which I think would be a great idea. I think she brings up a great point, that if you take your rentals here in Buffalo and do an exchange, which is not hard, we have Russ Gullo.
Right, yep, he's a great tool to have.
And so what basically you have to do is you have to take these rentals in Buffalo and find another piece of investment property in Florida where you're going to, and that's not hard to do. And you basically take the basis on this, which would be zero, if it is zero, and you move it to this new property, which if it's the same amount of money is going to be zero. But the whole thing is kind of deferred until you absolutely get rid of it in Florida, and you pay zero now. Now, the only thing is, you gotta want to,
Be a landlord again.
Landlord again.
Yep,
Right,
yep.
right.
but you can do things like investing in like a Family Dollar. I know that Russ Gullo helps with people that would like to be kind of a more passive investor. So you don't have to be that hands-on landlord, but you can actually do the 1031 exchange and get rid of the whole game
And I think a really
completely.
good idea is, we have so many clients who, before they sell a place, they come in and do a consultation, and then we'll show them what the capital gains are, and they'll go gulp. And it's really enlightening. So the truth is, before you sell, before you make a decision on your investment property, sit down and we'll show you
because
what the capital gains
if
are
you're
going to be.
selling property in New York State, I mean,
Right.
New York State recognizes a 1031 exchange too. So you're moving it to Florida, that's another benefit. But if you have to pay the 20% to the federal, plus New York State, let's say 8%, so you're almost paying 30% on $1 million, which is $300,000. That should be a pretty big incentive, I would
Right.
think, to look into that. So that's what my suggestion would be. Chris, you want to
No,
add?
I mean, I just want to say, you cannot do that yourself. You
Oh, no,
cannot.
you can't.
You know, we've taken phone
phone
calls
calls.
where people, I have 10 days left, what am I supposed to do?
And they already have the
And they
proceeds.
took the cash and put it in their own bank account. You can't do that.
Yeah.
You need the mediator. You
Right.
cannot handle this
And
transaction.
because on a 1031 exchange, you can't take any cash. All the money has to go, it has to be handled by a third party who then moves it over without you touching it. Any money you take is taxable money.
Yep.
And then why don't we talk about, if pretend like this person wanted to move to Florida and they didn't have a rental. So when you're a New Yorker and you move to a different state, make sure that you pay attention. Chris always counsels people about their health insurance. Also, if you move to a new state, it has to be more than 6 months and 1 day, so make sure your voter's registration, you get a new driver's license, any other
Well, your
education.
intent has to be to leave New York City.
Right,
Yeah,
right.
Yep.
Yep.
Okay, why don't we take,
But
So-
wait,
oh,
just
what-
wait, sorry.
yes.
One, you brought up the point. You're leaving New York and you're going to Florida. What's the tax rate in Florida?
Zero.
Right. So if you sold and you had $1 million gain here at 7%, that's $70,000.
Right.
So maybe you only want to be a landlord for 2 more years.
right,
Because once you're in Florida for 2
That's
years,
sneaky.
that exchange is committed.
right.
So now Florida has no tax.
Right.
You just saved $70,000 by waiting 2 years.
That's correct.
So, I mean,
Tax
that's.
Not to
planning.
mention the estate taxes and everything.
Yep.
I
Tax
mean,
planning.
we are in a very heavily taxed area.
Yes.
We love Buffalo. but
Very good
It
point.
is very heavily taxed. Okay, why don't we go back to Dom? We got another question, Mr. Dom?
Hi, Esther. I'm here with Mick, and Mick has a question for you.
Hi Esther, here's my question. We sold our home last year at a record price. When we bought it in 2000, we paid $100,000 for it, but made improvements of over $30,000 over the years. If we sold it for $250,000, how do we handle the capital gains?
Why don't you give the good news?
Good news. So it sounds like this is a couple, and if it's their personal residence, they don't have to worry about, excuse me, capital gains unless it's greater than $500,000. If it's a single person, it's $250,000. So the good
In
news
gain.
in gain. So the good news is there is no tax. They just get to enjoy all the proceeds, all the profit, and don't have to report any of it. So
And
as Esther always says, a personal residence is a great
I mean,
investment.
you tell me what other vehicle, except for the 414H, 401H on the federal government, where you basically aren't taxed on money that you put in, like a personal residence. I know myself, what I have always done is every 2 years, I buy and sell my personal residence.
Did you
so
hear
that
that?
I can
We're gonna
take
sell our
in,
house soon.
so I can take advantage of the gain, not pay taxes, and I buy another because I like to decorate, you know.
Oh, that's your thing.
And so then I roll over that gain into the next house, which you don't even have to, but I always do. And you have tax-free money. And so it's a great investment vehicle. Now, I know people are probably sitting out there and saying, oh my gosh, I hate moving. But if you just made a big profit, and let's face it, real estate in Western New York is going through the roof.
It is going through the roof.
If you just made a gigantic profit, it really gives you an opportunity to buy that fixer-upper.
Now, the truth is, if this
And
was,
I love HGTV.
yeah,
by the
if
way.
this was their second house, then that would be a Schedule D transaction. And
But this is a personal residence.
right, just expanding on this. If
Right.
it was their second house, it would go on a Schedule D, and they would have to worry about capital
Right.
gains.
But on a personal residence, for all you that are looking for a great way to have a pile of tax-free money, your personal residence that you lived in 2 out of 5 years, every 2 years you can sell your house, take the gain, not pay any taxes. And if you don't want to reinvest, you don't have to. In my case, I always reinvest, and I love
Right.
HGTV. So, okay.
No
All right.
plug there.
All right, Dom, we got another person wanting questions answered.
Hi, Esther. We are planning on giving our family home to our children so that the nursing home can't take the cash out of it. Who do we talk to in order to get this accomplished?
Okay, so why don't we talk about that? First of all, we know that if you gift away a home, that isn't the best way to do it. Why don't we explain the gifting and everything? Chris?
Sure.
Okay.
Oh, yeah, absolutely. So the law says if you gift somebody something, it goes back to the original basis. However, if they inherited the house, then they get the stepped-up basis. So the truth is, it would be far better if they inherited the house, but if you gift it to them, then it's like this wah, wah,
So
wah.
what would be the best way to have them inherit the house, Chris?
The best way to do it, to protect it from a nursing home, would be a life estate. So, and that's where the owner, the parents, would retain ownership, control of the house, and when they die, it automatically goes to the children. But the caveat is, during that meantime, it's really the kid's house. But according to the government, it's not. So it's a nice little shield.
Loophole.
Yeah, a loophole. Because if the parents, and when we teach this all the time, I say, you know, someone does it when they're 65. It's almost too young to put it in a life estate. But because if they were to sell it when they're 80, because their kids moved down south, moved wherever, then the kids have to report the sale of that house on their own tax return. Not the parents, even though the parents sold the house, the kids do. And it's the kids' money. So if they turn around and give the money back to mom or dad, then
The money's all at risk again.
the money's at risk again. So the 5-year look back is there.
Right.
So you got it. The timing
All right,
has
so
to be
let's-
right.
Let's kind of walk through this. If mom and dad retain ownership and sell it at any point in time, it's going to be a tax-free event, just like we
Right.
talked about before. But if mom and dad gift the house to the children while mom and dad are relatively young, then, and at any point in time, the house is sold, once it's been gifted, the children end up paying a big capital gain.
That's right.
Sorry. Unlike the previous question where it was their principal
Right.
residence. So here, if mom and dad bought the house for $30,000 back in 1965, put $40,000 into it, their cost basis is $70,000. They sell it for $250,000 while they're alive. In this life estate, the children would have to pay tax on $180,000.
Right. So the whole thing is you don't put the house into a life estate unless you're planning on keeping it in the life estate until your demise.
Another thing is if this does happen and somebody is gifted the house, this is where record keeping is really, really important. So I would encourage anybody, even if you have a personal house, Chris's mom is a phenomenal record keeper, and keep track of the roof and the sidewalk and the remodeling. Record keeping is really important in whatever you do.
Right, and the other thing is that's really important is to understand that if you are somebody that wants to gift your home to your children, sit down and make a list of all the improvements that you've made to the house over the years, so that that if the children should need to know the adjusted basis, that's already been answered, right? Okay, Dom, do we have another question?
We have 4 rental properties in a business. The rentals always show a loss after depreciation, but the business has been making around 80 grand. Any suggestions to maximize the pass-through deduction?
Okay, so Dominic, that's a big question. So why don't we first start off and talk about what the pass-through deduction is, who gets it, and this is brand new this year.
It is, yep.
Right, brand
Chris,
new.
you got this.
Yep. So whether you're self-employed, you are part owner of a partnership, part owner of an S corporation, or even rental properties, this 20% pass-through will benefit you.
Right.
It doesn't come off the bottom line of that type of entity you have. It goes on where the old personal exemptions used to be. So you got your adjusted gross income, you got your standard deduction or itemized deductions, then you have the 20% pass-through.
So, and it's actually reduces the taxable income.
It reduces,
Right.
yep.
And these folks said that they had a profit on their business and they had a loss on their rentals, so you have to net it together, right, Chris?
Yep, well, depending on their rentals.
Right.
Because rentals, you have to run like a business. It
Right,
can't just
right,
be, oh, I have.
casual rental.
A casual.
Separate account.
I have one little house I rent out, and it's my daughter who lives there, and because that's not a business.
So it has to be you have to be self-employed, partnership, subchapter S corporation, and if you have a net profit on that, or a rental that you're operating as if it's a business, and you have a net profit on both of these after depreciation, then the bottom line, when it's added together, times 20% would become this pass-through deduction.
Correct.
However,
That's so
if you have a
easy.
rental loss and you're acting as
As
a
a-
business,
yep.
then that's a horse of different color, right?
Right,
So
right.
why don't we do this? Because this gets to be very complicated. Why don't we just hold us up to the other side of the
Yep.
break? I'm Esther Golias, the tax lady from EG Tax. We're helping you answer your tax questions. And don't forget, if you need us during the week or any of our offices, all 30 of our branch offices are open, and you can actually call and ask a tax question to a human being, and we will answer it at any of our branch offices. There's no charge. Or you can go to our website and just type it in at Ask the Tax Lady at egtax.com, and we're there to help you at any point in time. So we're dealing with pass-throughs. This is a brand new deduction, and it's very complicated. So we're going to take a short break, and we're going to be back on the other side to discuss this further. I'm Esther Golias.
Good job. Good job.
Ready to roll again?
I wonder who those clients are for, Tim?
Tim, probably.
Ready?
We're ready.
Stand by and action.
Hey, I'm Esther Golias, the tax lady from EG Tax. We're talking pass-throughs, we're talking new tax law, and we were kind of chewing it up. We had a question that Dominic had about somebody that had rental property and a small business. And so the bottom line is the 20% deduction that they're giving you was initiated because of the reduction
Right.
in the tax rate on C Corps.
Right,
Correct.
Right.
So this is kind of a way to
And
to help,
make it
even
the
though
same.
the C Corp thing isn't
And
a
then
good thing.
explain,
for folks.
Esther and Chris, if you would, on the small business, why the code of your business is really important.
Okay.
Because the $350,000
Right.
limit.
So let's also talk about, so you can get that 20% pass-through if your income is under $350,000 filing a joint return, half that amount if you're single, correct?
Correct.
That's when you qualify for the pass-through. Now it gets more complicated if your income's over that because there's a phase-out. There's a $100,000 phase-out from $350 to $450 if you're joint, and an extra $50,000 for half of that amount if you're single. Then, once you get over the 450, unless you have the correct business code, then you aren't entitled to, especially if you have a service business, if you are an accountant, stockbroker. If you're the wrong business code, you're not allowed the 20%
Right.
at all. If you have the correct business code, then there's another way of computing that 20%, which has to do with payroll and assets, right?
Correct.
So that's
But,
very
yeah,
easy,
so,
not.
this person, if they wanted to treat the rental properties as a business, which means they have to have a separate checking account, everything has to be handled just like you had a shop selling
Right.
toy trains.
Right.
Okay, everything has to be separate. If they want to do this, and now they're saying they had losses, this is going to hurt them with
That's
their
true.
20% pass-through.
That's true. I mean, I suppose there are, and this will probably be something that'll be audited as we
Yeah.
go forward. Let's say you have 8 rentals and you kind of commingle and you really don't, you kind of run it out of your back pocket. Well, according to what they were saying at
Yeah.
the training session we went, oh, that's not considered a business. Well, if they're operating at a loss, really, if you think about it, they may say, well, we think that's a business
Yeah,
because
yeah.
we want that loss to offset the
That's right.
gain.
That's
So
right.
this will be interesting as things move forward.
Yeah,
Oh,
very good
definitely,
point.
definitely. And I know they said
So
at the
it sounds like
training.
we're begging the question, but really I think that taxpayer needs to come in and see us so we can go over whether or not they get the 20% pass-through. And we also want to set it up to make sure that, especially if you have rental property, that you're handling it as a business, especially if it's producing an
And I know,
profit.
I don't want to beat this horse
To death.
but the 20% doesn't impact the net profit if you're self-employed. You're still going to pay self-employment tax on the net profit.
Right. When they first wrote the law, I thought, oh my gosh, it's going to save everybody FICA, but it isn't.
No.
You know, and you want to make sure that you don't play games with your, because let's say that you have an S corporation and you were taking a $100,000 salary and your net profit, let's say, was $200,000. So you say, well, what I'm going to do is I'm just going to have my net profit be $300,000. So my pass-through is an extra $20,000. That doesn't cut the mustard. You have to make sure that you're getting a fair salary for what you're doing. Got to make sure that you're paying yourself a fair salary, or else you're going to get audited and just ruin your life for
And don't
how
forget,
long
you
it takes to do
started,
that.
you started this whole conversation with the reason they did this because they lowered the rate for corporations. So corporations have a new flat tax rate, but it might affect some people who really were paying a lower rate for their corporation. Now it's going to that 20%.
21%.
21%. So you really want to be careful if you were a
If you're a C
corporation.
corporation,
And your income wasn't that high, you might want to readjust and make yourself an S corp.
Right. Okay. Well, I'm sure we've just confused everybody.
I
think
believe
we did a
so.
good job confusing ourselves. Okay, Dom, we got another question out there?
I have an S corporation and I've been taking a salary of $40,000 each year. But with the pass-through deduction, wouldn't it be better for me not to take a salary to increase the pass-through?
Sort of
I
answer
think I
that.
have a crystal ball. Okay, so that's what I was just saying. It is true. With the pass-through, that, you know, if you eliminate that $40,000 salary, 20% of the $40,000 is $8,000 extra, 20% you would get. And you think, what a smart person I am. Wrong. Everybody that has a C corporation has to pay themselves a reasonable salary for the services they perform. Otherwise, you're violating wage and hour. So and what they're going to be doing is they're going to be looking through those K-1s that come in to make sure that the owner has a salary on that S corp, or else they're going to audit you and then just allocate it back.
Right. Also, what they're doing too is if you're a single owner S corporation, they're going
The
to
whole
tax
thing
the
is-
whole profit. You're going to pay Social Security and Medicare tax on now.
Right.
Even though you may have taken, he may have gotten have a $40,000 profit and taken, or $40,000 in wages and had $60,000 left and thinking, okay, I just saved FICA on
the
60.
yeah.
But if he's the only person doing the work, they're going to say, no, you didn't.
Right.
It's all.
And you have to really be careful about that because, you know, you think you're pulling out a rabbit out of a hat, but what you're doing is you're really kind of burying yourself. So to make it simple, let's say that you're what's a good thing where, let's say you're a dentist.
Right.
All by yourself. You're a solo dentist. You take care of the front desk. You take care of the teeth. There's nobody. You're an S corporation, and your net profit's $100,000. And so you say, I think I'll take a $50,000 salary, and the rest of the $50,000 will come out as a net profit. If you're the only person producing that income, really the whole $100,000 has to be considered like wages, and you have to pay FICA on the whole 100. Now you'll be able to do a solo 401k,
Yep.
right?
Yep.
Big, huge solo
Yeah.
401k.
Yeah.
But unfortunately, the FICA on the
Doesn't go
whole
away.
on the whole enchilada. Conversely, let's say you start off as a single dentist. And then you have 3 other dentists, and you got Laura the receptionist, and 12 teeth cleaners working for you. Oh, well now your subchapter S corporation is got multiple people producing the bottom line. That's different.
Right.
Right?
Yep.
Wow.
Yeah. And you know, and I know we're doing tax questions, but it's pretty talking to clients. I'll say, why don't you hire somebody and you can make more money? But I don't want to pay anybody. It's so, but that person may bring in $50,000 and it costs you $20,000 to pay them.
Right.
And so you're up $30,000, but it's getting over that initial.
Well, and there's no doubt about it that obviously if you're all by yourself working, you're going to get 100%.
Yep.
But if you can duplicate yourself, you are going to pay for that duplication, but now you're getting the net profit on 3 or 4 other people after
Yep.
you pay
You
the
have
salary
to-
that you could have never
You
done
have to
by yourself.
budget in growth,
Right.
is what
Right.
you always say.
Right,
Yeah.
absolutely. But we still are open in McKinley Mall, and
that's
that's
it?
it.
Only
That's
one
the
mall
McKinley
again.
Yeah, because
Our
malls-
Boulevard Mall office, we moved to Niagara Falls Boulevard. And by the way, our corporate headquarters is now at 1890 Colvin, and the 2475 Niagara Falls Boulevard office was our corporate headquarters. It's still a branch office, and we have a wonderful staff over there, but our corporate office moved to 1890
Yeah.
Colvin, near the Blue Jet.
Right, right.
That's right.
Brighton and
And-
Brighton and Colvin.
Correct.
Right, Brighton, which is
And
Maple.
on Tuesdays, we're having Tax Tip Tuesdays, so it's a internet blog, so if you're interested in any exciting tax tips, Tim Eliason, our marketing director, and I are doing Tax Tip Tuesdays. And
That's
you can
always fun. And the other thing is during Saturdays, we're on WBEN from 3 to 4, and of course every Tuesday here we're on WBBZ. If you have any questions, we're here to help you. Give EG Tax a call. Visit us on our website. Until next week, I'm Esther Golias, the Tax Lady with Christopher Fabian, Tiffany Fabian. Have a great